Okay, so are we heading into a major economic downturn? I mean, if you're listening right now, you might already be feeling it a bit,
Hmm.
maybe noticing prices creeping back up at the store, at the pump.
Yeah, definitely hearing that.
Or perhaps you know someone who's, well, been impacted by job cuts recently.
It seems more common now.
Or maybe, just maybe, you've seen those, familiar signs of panic buying starting to reappear in certain places.
That's an interesting one, yeah.
Look, while the debate about whether we're technically in a recession rages on, the reality for average Americans feels pretty clear from the material we've been exploring.
Right. The focus here is on what people are actually experiencing.
We've been digging into a stack of notes and articles, specifically looking at content titled Signs of Coming Recession, Inflation, Layoffs, and Panic Buying.
Got it.
And our mission for this deep dive is really to unpack what this material says is truly happening in the U.S. economy right now. We're going to break down the latest data presented, look at why layoffs seem to be increasing across sectors, according to this analysis, and explore how consumer behavior is shifting. So if you're worried about your job, your savings, or, your investments.
Which many people are.
Exactly. The insights we pulled from this source material are, frankly, crucial for navigating what could be ahead. Okay, let's unpack this.
Yeah, and what's striking from this material is how it connects these seemingly separate events.
Right.
It argues these aren't just isolated incidents, but signals.
Yeah.
Signals of a brewing financial storm.
A storm, okay.
So our goal in this deep dive is to bring some clarity to those connections and present the actionable steps suggested in the source, focusing purely on the insights from this material.
Absolutely. And the first key signal this analysis points to is something we've talked about before, but it seems to be making a concerning comeback: inflation.
That's right. After some, encouraging months where inflation seemed to be cooling off.
Yeah, a bit of relief.
The recent reports highlighted in this material show a disturbing reversal.
And the specific numbers presented are pretty stark. We saw notes that the Consumer Price Index, the CPI, it rose 4% just in April alone.
Yeah, that pushed the annual inflation rate back up to 3.5%.
Right, up from 3.2% in March. And what they call core inflation, that's the number excluding, volatile food and energy.
Yeah, the underlying trend.
That's noted as remaining stubbornly high.
And if we look at the impact, what this means for you, the listener, is pretty straightforward. Inflation erodes your purchasing power.
Right.
Your paycheck effectively buys less than it did before.
Just doesn't stretch as far.
Exactly. And this material points out that this pressure can force people, especially those on tighter budgets, to, dip into savings. Or rely more on credit cards just to keep up.
And the examples of price increases in the source really underline this. It mentions energy prices rising again, particularly gasoline.
Which everyone feels.
Which it links to increased global demand and production cuts by groups like OPEC+.
Right, the Organization of the Petroleum Exporting Countries and their allies.
And food prices are also spiking. Staples like eggs, bread, milk are cited as being up a painful 8-12% year over year.
Wow, 8 to 12%. That's significant.
It really is.
Precisely. And this persistent inflation has significant implications for the broader economy and policy.
Okay.
The analysis highlights that despite some signs of slowing growth, this inflation means the Federal Reserve may feel, compelled to keep interest rates high.
Or even raise them again.
Or even increase them further, yeah.
Yeah.
And this makes any kind of borrowing significantly more expensive. Financing a car, buying a home.
Credit card.
Or just carrying those credit card balances, it all costs more.
So the clear takeaway from this first sign, according to the analysis, is that inflation isn't just an abstract statistic, right?
Not at all.
It's a direct hit to the average American's finances and a major indicator of sort of mounting stress in the system.
It certainly is. And this leads directly, I think, to the second major signal identified in the material: layoffs.
Layoffs. Yeah, we've heard a lot about cuts in the tech sector, obviously.
For a while now.
But what the source material emphasizes is that these job losses are now spreading beyond just tech.
Right.
And hitting sectors traditionally considered, pretty stable.
It's notable how many well-known companies were mentioned as having announced significant cuts in just the past 3 months.
Yeah, who did they list?
Amazon, Tesla, Disney, and UPS are all listed in the material.
Wow, okay. Big names.
Very big names. And the reasons given for these cuts vary, from companies sort of trimming fat after maybe overhiring during the pandemic.
Great scaling back.
building up too much staff too quickly, perhaps, to simply reacting to slowing consumer demand and rising operational costs.
Okay,
But the underlying theme seems to be employers preparing for, well, leaner times.
that makes sense.
And the analysis elaborates on where else these cuts are hitting, specifically mentioning retail and logistics giants like Target, Macy's, and FedEx.
Retail and logistics too. Why there?
It attributes these job cuts largely to weak consumer spending, and construction and real estate firms are also noted as laying off workers.
Ah, because of interest rates.
Exactly.
Yeah.
Which the material links directly to high interest rates, dampening new development and home sales.
Okay, so looking at this from, your perspective, listening right now, even if your job feels secure,
Right now, yeah.
this suggests that overall job security across the board is maybe shrinking a bit.
It seems that way. And these cuts have ripple effects, right? Impacting local economies and potentially reducing overall consumer spending even further as people get, well, nervous.
Yeah, it feeds on itself.
Exactly. And from an investor's perspective, as pointed out in the analysis, a weakening labor market typically signals slower GDP growth,
Okay.
which can negatively impact corporate earnings and, in turn, stock prices. However, the material does offer a potential silver lining here.
Oh, what's that?
If you're taking steps like building emergency savings, maybe upgrading your skills or diversifying your income now,
Being proactive.
you're positioned better to weather this trend.
Okay, so we've seen inflation biting into budgets, and now this material turns our attention to maybe more alarming trend, job security challenges. But the third sign highlighted in the analysis is perhaps the most visually striking and frankly a little unsettling.
Ah, yes, the return of panic buying.
Exactly. The material draws a comparison to the early days of COVID. Those images of empty shelves and long lines.
Yeah, feels like a while ago, but memorable.
It does. While it notes today's version isn't quite as extreme, the signs are apparently returning. It mentions consumers stocking up on essentials again.
Where are they seeing this?
In specific cities like Los Angeles, Chicago, and Miami were mentioned.
Interesting, okay.
And there was a specific data point highlighted from a Nielsen IQ report showing that sales of bulk items like rice, beans, cleaning supplies surged a remarkable 20% compared to last year.
20%. Wow. And the reason given in the analysis is rooted in psychology, basically.
How so?
Economic fear triggers survival behavior. It's instinctual.
So when inflation is up and layoffs are looming, people instinctively start, preparing for potential disruptions.
Precisely. The material describes this as creating a kind of feedback loop.
Okay.
Increased demand leads to temporary shortages, maybe just perceived shortages.
Right.
And those perceived shortages then drive more panic buying.
Ah, I see the loop.
And retailers, according to the analysis, are already responding by, say, reintroducing purchase limits or trying to ramp up supply.
But the analysis says this is deeper than just a supply chain issue, right? It's not just about toilet paper this time.
It does. It argues it signals a lack of trust in the economy's stability. When people lose faith in things remaining predictable, well, they act accordingly. This behavior, the material points out, impacts everything from spending patterns to the performance of retail and manufacturing stocks.
So it's a sentiment indicator.
It's presented as a significant warning flag about where public sentiment is headed. Yeah.
Okay, so putting it all together then, we have rising inflation, spreading layoffs, and this creeping consumer panic buying. This analysis says these trends are interconnected.
They are. And viewed collectively, the analysis concludes they form a compelling warning that the U.S. economy may indeed be heading into a recession.
Which brings us to the crucial part for our listener. Okay, so the material lays out the signs, but the really important question is, what does this actually mean for your personal finances?
This raises an important question, definitely. And the material provides some actionable strategies based on these signals.
Okay, what are they?
For someone living, say, paycheck to paycheck, the advice found here is clear. Revisit your budget, like right now, and prioritize building a 3 to 6 month emergency fund.
That's safety net.
Exactly. And critically, eliminate high-interest debt, especially credit card balances, as rates are expected to remain high.
Get rid of that expensive debt. Okay. What about investors?
For investors, the analysis suggests it's not time to panic, but it is time to rebalance.
Rebalance how?
Maybe consider shifting assets to more defensive sectors. Think utilities, healthcare, consumer staples, things people need regardless.
Right, less cyclical.
Increasing exposure to bonds or dividend-paying stocks for stability is also mentioned as a strategy in the material.
Okay. And real estate. That's always a big one.
The material advises caution for real estate investors.
Mhm.
Higher interest rates combined with potential layoffs could cool the housing market.
Makes sense.
So the recommendation is to focus on cash flowing properties if you have them and avoid over-leveraging, meaning, taking on too much debt relative to the property's value.
Don't get stretched too thin. Got it. And for small business owners, lots of listeners there too.
Right. Small business owners, according to this material, should prepare for changes in consumer behavior.
Look what?
Expect more value-conscious spending, maybe longer decision cycles before people buy, and increased price sensitivity.
So tighten the belt operationally.
The analysis advises streamlining operations, and doubling down on customer loyalty, but across the board for everyone.
Yes.
The material stresses the importance of financial education, stating that in times like these, information is your best asset.
Knowing what's going on and what you can do. So bringing it all together, what prediction does this material actually make for what comes next? Is it doom and gloom?
Well, based on the trends it observes, the analysis predicts the U.S. will experience a mild to moderate recession
Mild to moderate.
within the next 6 to 12 months. That's the time frame mentioned.
Okay, 6 to 12 months. And what's the basis for that specific prediction? Mild to moderate.
The analysis states that the combination of high interest rates, persistent inflation, weakening job growth, and falling consumer confidence creates what it calls a perfect storm.
Okay, the perfect storm idea again.
It makes a comparison, suggesting it might echo the 2001 or maybe the early 1990s recessions.
So not 2008.
Less severe than 2008 is the implication, but still potentially painful.
Right. And the action plan outlined in the material, just to recap, specifically for different groups again.
Sure. For investors, stay diversified. Try to avoid emotional trading based on fear.
Easier said than done sometimes.
Absolutely. And look for long-term value. Market corrections do create opportunities, but the analysis notes that timing the bottom is notoriously hard, maybe impossible.
Okay. And for workers.
For workers, upgrade your skills now. The thinking is the job market will likely become more competitive. Adaptability is key.
Makes sense. Be prepared.
And for everyone, increase financial resilience, whether that's through side income, boosting savings, or just making smarter spending choices. The message is that every step taken now helps later.
History shows that recessions, while definitely difficult, can also create opportunity. The question posed is, will you be prepared to seize it?
Indeed. It's about preparation.
So the signs are there, according to this material. Inflation rising, layoffs spreading, that consumer panic kind of creeping in. While the exact timing or depth is, unknown, the analysis suggests the signals are clear.
The warnings are present.
But this isn't about fear. The material frames it as being about foresight and preparation. The difference during a downturn often comes down to being prepared.
That seems to be the core message.
And the concluding advice pulled from this analysis is crystal clear. Take control of what you can today.
Focus on what's in your power.
Look hard at unnecessary spending. Build your safety net, strengthen your skill set, and stay informed.
A powerful message derived from this deep dive, really, if we connect this to the bigger picture. Knowledge and preparation aren't just helpful in uncertain times.
No.
They are, perhaps, your greatest assets. It's definitely something to consider as you navigate the coming months.